What's up, guys? I'm Dave, the Military Millionaire, and today we are going to talk about loan costs that are associated with the VA loan or closing a mortgage in general, and what you need to be looking out for, because I get asked this all the time. Now, I will say that the numbers in this video are going to be not necessarily 100% accurate because they change. So depending on when you watch this video, I might be a little bit lower, a little bit higher. It's also going to depend on your market and the purchase price of the property, but it will give you a very good idea of what to go off of and what to be looking for. So I hope this helps. Cue the intro. All right, lately I've had several people ask me to help them understand loan closing costs and fees to watch out for. Unfortunately, I see service members and veterans get burned all the time by unnecessarily high closing costs and fees. So know this. It is entirely possible for a lender to give you a great interest rate and still be the worst loan option because of these fees. Now, that is why you need to know what you're looking at when it comes to receiving loan closing costs and documents. So first off, what are closing costs? Closing costs are the myriad of fees that you pay when finalizing a mortgage. Now, anytime you purchase a home or refinance, you will be subjected to paying closing costs, unless of course you get the seller to pay them all as a part of your negotiations, which is possible. Now, how much are loan closing costs, right? So they're generally going to range between 2 and 5% of the loan amount. So on a $100,000 mortgage, you'd be looking to pay between 2 and 5 grand for closing costs. The most affordable way to cover your closing costs is to pay them as a one-time expense, right? There are times where you can wrap the closing costs into the loan in order to finance them, but then you're going to be paying interest on them for the entire duration of the mortgage. So, that's more expensive, but it might be worthwhile if you didn't have the cash for closing costs, or you couldn't negotiate them out of the sale, and then financing them was still you'd still cash flow. It might not be as great a financial decision long term, but it is what it is. Now, sometimes you can negotiate with your lender, or you can shop around with different lenders to lower your potential loan closing costs. My favorite way to lower closing costs, though, is to convince the seller to cover some or all of them. For example, let's say you have a home on the market for $100,000, and I offer you $10,000 under the asking price, so $90,000, and then you counter back at full price because you think it's actually worth $100,000. I may agree, but then say, hey, but I want you to cover all the closing costs by doing this. And by doing this, I'll have a little more on the mortgage than my original offer, but I won't have to put nearly as much money down, so the numbers could work out for me better. Now, when do you pay closing costs? You will pay the loan closing costs at the end of the loan process, otherwise known as closing day. These costs can be prepaid at closing or wrapped into the loan, depending on what fits your financial situation the best. There are recurring and non-recurring closing costs. So recurring costs are those things like mortgage interest, principal interest, taxes, insurance, annual fees, and any costs associated with the loan that is paid continually throughout your ownership. The first of these is mortgage insurance fees, right? So mortgage insurance is required on any loan that you pay less than 20% down for, with the exception of the VA loan. Another reason the VA loan is incredible. Now, sometimes the first year of this fee is paid up front, but more often than not, private mortgage insurance, or PMI, is tacked on to your monthly payment. If you use an FHA loan, you'll also be required to pay a mortgage insurance premium. So, just make sure you're aware of that. Now, they're all fairly standard fees. Just make sure you understand what they are up front from your lender. You're always going to have to pay property taxes, annual fees, insurance, whatever. Just make sure you get with your lender and you understand what those look like. So property taxes, your lender may require you to pay 1 or 2 months of them up front when you close on the property. But either way, you're going to be paying property tax for the duration of ownership, unless you're in a state that waives them for disabled veterans or something like that. Annual assessments. So if you're purchasing a condo or a property with a homeowners association HOA fee, they may require annual fees or monthly fees. In fact, I don't know any HOA that doesn't have some kind of fee. So just know that you need to be aware of that. Homeowners insurance premium. Your lender may require you to carry homeowners insurance on the property to protect their investment. In fact, I'm pretty sure they will. As you can expect, these insurance fees are recurring for the duration of ownership as well, because you're insuring the property. And then non-recurring fees. In case you can't put 2 and 2 together, I'm looking at you, Marines. You have probably figured out that non-recurring fees are in fact not recurring. These are the loan closing costs and fees that you pay up front and you should never have to pay again, right? So the first one is property related fees. This is things like your home inspection. Whenever you go under contract on a property, one of the first things you do is order a home inspection to make sure that your investment is a good investment. Most lenders actually require this, but it's a good practice to order a home inspection regardless until you get really familiar with what you're looking at and you're comfortable with assuming that risk, right? I don't recommend that right off the bat. Before lending you hundreds of thousands of dollars, the bank wants to ensure that the property is structurally sound. You should too. So inspections will vary based on what kind of property it is, and how big, but they're generally average between $300 to $600. Next up is the appraisal fee. Lenders also want to confirm that the property is actually worth at least as much as you're paying for it. So for this reason, you will need to hire an appraiser anytime that you apply for a loan to purchase a home or refinance. Loan-related fees. These are the fees that lenders have more control over, but they can fluctuate a little bit. So there's things like the application fee, which is used to cover the processing, the cost of processing your request or your application for a new loan. So that's going to cover the costs associated with like your credit checks, your administrative requests, and whatever. Obviously, these fees will fluctuate based on the lender and their processes, but the fee is basically just passed through to you so that the lender doesn't have to pay any fees associated with processing your application in the chance that you don't actually qualify for a loan or even use them. So yeah. All right, the assumption fee. This only comes into play if you're assuming the seller's mortgage, and if applicable, this fee would be based on the value of the remaining mortgage balance that you're taking over. And then there's prepaid interest. So let's say you close a loan on January 15th, but the first mortgage payment isn't due until March 1st. In this scenario, the lender will most likely charge you upfront for the interest that occurs between the day you closed and the first monthly payment rather than tacking it onto the first payment. Now, loan origination fees is the next one, and this can be a beast, so you never know, right? These are also known as the underwriting fee or the processing fee or sometimes the administrative fee. In essence, this fee is one of the ones you really need to pay attention to because this is one of the fees that lenders can tweak, they can overcharge for or hide expenses to give you a lower rate so that you, in essence, they could lower your rate, put a bunch of stuff into your origination fee, like buying down points or whatever, and they might be able to hide it there. I've seen it. You should expect to pay between 0.5% to 1% of the loan cost in origination fees, or like $500 to $1,000 on a $100,000 mortgage, right? Now, attorney's fees. Your state may require an attorney present at the closing table, and that would be another fee associated with their time. So the number of hours the attorney's at closing will determine how much this costs. And then there's a mortgage broker fee. So if you work with a mortgage broker to find a loan, instead of with a direct to seller lender, they'll often tack on this fee as their commission for helping you find the loan. So this commission generally ranges from 0.5% to 2.75% of the home's purchase price, and that's something you should iron out before working with a mortgage broker. Also, when you're going to work with a broker instead of like a direct to seller, be aware that brokers often take a little longer to process loans, and it's not their fault. It's just that they have to work within the confines of whatever wholesaler they find, instead of having like everything lined up in their system where they control the pipeline. So it's kind of a normal thing. Discount points. By paying discount points, you can reduce the interest rate you pay over the life of the loan. Sometimes that's absolutely worthwhile, and sometimes it's completely unnecessary. It's going to depend on the size of your loan and the interest rate you're qualified to lock in and whatever. So one discount point equals 1% of the cost of the loan. So if you pay 2 points on a $100,000 loan, then you will be paying $2,000 to buy down that loan interest rate. So that's going to make more sense the longer you plan to stay in a home. So the longer you plan to stay in the home, the more valuable buying down the rate generally is. And then there's title fees, which are what the title company will charge to ensure that you purchasing a home with clean title. Now, the lender is going to require you to run a title search and probably get title insurance. I recommend it anyway, and that's just for qualifying for their loan. But title search fees, title search is conducted to ensure that the person selling the home is the legal owner. Right now, I am currently dealing with a home that I'm under contract on. I wasn't able to close on Friday because the person who owns the home had tried to seller finance it to somebody else, and they need to quit claim it back into his name to sell it back to me, and that hasn't cleared yet. So the title search and everything is there to protect me. It also verifies that there's no outstanding claims or liens against the property, so that can be fairly labor intensive depending on how well kept the real estate records are. Title search fees generally hover around $200. It can vary around the title companies in your market, so just take a look. And then there's owner's title insurance. You'll probably want to consider paying for title insurance to protect yourself against any issues that arise with title after closing. It's rare that these issues will arise, but you never know, and title insurance is not that expensive, generally like 0.5 to 1% of the purchase price, so it's definitely worth looking into. Lender's title insurance, most lenders are going to require a loan policy which protects them in case there is an error in the title search, so if lenders want it to protect their investment, you probably should. And then here's kind of a summary of mortgage closing costs. So here's an average breakdown. Again, it's average, and this is going to change based on years and all kinds of in market and all kinds of stuff. But and lenders. But here's kind of the average of what to expect. The appraisal fee, $300 or $400. Home inspection, $300 to $500. Application fee varies. Assumption fee varies. Attorney's fee, hourly. Depends on how long they're there. Prepaid interest, it's going to be based on the loan amount. Origination fee, about 0.5 to 1% of the loan. Discount points, 1 point costs 1% of the loan amount. Mortgage broker fee, 0.5 to 2.75% of the loan amount. Mortgage insurance application fee, it's going to vary. Upfront mortgage insurance, 0.55% to 2.25%. FHA, VA, and USDA fees, 1 to 3.3%. Property taxes, 2 months worth. Upfront HOA fee, it's going to vary on your homeowners insurance, homeowners association. Homeowners insurance depends on the home value and the location. Title search, about $200. Lender's title insurance varies. Owner's title insurance, 0.5 to 1% of purchase price. Look, junk fees. You need to avoid junk fees or garbage fees that are tacked on to most mortgages. There isn't any way to completely ignore these fees, but you can at least minimize them most of the time. So look for unnecessary processing and documentation fees in the below categories, right? So application fee, mortgage rate lock fee, underwriting fee, broker rebate, loan processing fee. Just make sure that you're aware if there's some large inflations there and then your interest rate is still low. The bottom line is this. You owe it to yourself to scrutinize the closing statement and all of your loan closing costs and fees. You need to know exactly what you're paying for and how it's going to compare to other lenders in your area. Now, I'm not advocating for rate shopping lenders after you've worked with a lender, with them for weeks on end, but I am saying you need to make sure that you aren't getting bent over by the lender at the same time. A lower interest rate doesn't always mean a more affordable loan. Make sure you look at everything objectively and not just the interest rate. People get so wrapped around what their interest rate is that they neglect the fact that the fees may be a lot more. So look at the APR, look at the fees, make sure you're comparing apples to apples. I have a roommate who does VA loans, and I have watched people go with another lender for a worse loan product that just had a lower rate or whatever, and they thought it was a better thing. And it's so frustrating because it's like, this person's getting screwed. They don't even know it. And often it's even more frustrating because like this guy spent weeks working on your thing. I've even watched where like he's walked them through all the mistakes that their lender went with, and then they still go with the other person. I don't understand. So just make sure you're getting the best deal for yourself, and remember that relationships are important. So make sure you make good decisions. If you haven't done so already, make sure you subscribe to the channel, smash that like button, and share this if you got something out of it. Have a great day, guys. I appreciate you.